Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today I'm going to go over some information. I was on Twitter and there's a lot of people posting up a bunch of different charts, a bunch of different data, a bunch of different things. And one, you got to look deeper than just kind of scratching the surface. You got to look deeper at the data. You got to get data, population by generation. You need to look by age. You got to look to see how this thing's basically coming about. You don't look at an overall population of everybody in the system. That's just not what you do. I'm sorry, guys. I don't know if people just they don't know how to look at data. I don't know if they're just lazy. I'm not exactly sure. But a lot of data that I see and a lot of people that draw conclusions from the data are just flat out wrong, in my opinion. And that is probably one of the most important things to understand when looking at data. And I don't know, maybe some people just don't have the ability to look at data and correctly analyze it. I don't know. You have to look at it from multiple perspectives, multiple ways. You want to look at it to see, you ask different questions when you're looking at the data, because data is not going to give you answers per se. What you need to do is you need to look at data and search for answers that you have questions for. So you're going to ask a question: does the population support a housing boom? The demographics. The answer is undeniably yes. And I've looked at the data. I've grabbed it, straight from Fred. The population data, the housing starts, all that stuff. I grabbed it straight from a lot of those areas. And if you look at it and you analyze it, the actual demographics goes up quite dramatically from the millennials all the way to 2024. But I don't know if the house, the home starts may or may not exceed that level in 2024. It depends how fast you build it. Now, it all depends on the rates that you can build it at, the supply chains that they can supply, and all those things. And remember, we're betting on the volume of loans, not the price of homes. That is the thesis. The thesis, probably, if you were to look at it and do a good estimate, it's probably going to run till about 2027, 2028. And I don't want to share some of this data with everybody because this is almost like proprietary stuff. I could probably write like a PhD on it, literally. And the people on Twitter, when the stuff that they write and the conclusions that they draw to, they're just not right. Like, they aren't right. And I don't want to sit there and try to argue with every single person of single thing and try to argue with everybody. It's like, no, just let them have their opinion. It's done. And then another thing that I've noticed is a lot of people, they're putting up a lot of charts and graphs. They're doing technical analysis with no understanding of the background. What I have here behind me is the background. And this is just some information. People like learning about information, and some of these are opinions behind me. Some of them are. But what I do is I look at data, and then I look at technical chart patterns in a paradigm of what I know of the fundamental background of the shortages that are coming. So I'm looking at that from that type of perspective. And even if you get a short-term pullback, it's just a buying opportunity. Why? Remember, the markets are forward-looking, and people kind of go off the deep end when they look at data. So they'll say, I'm just going to give an example, okay? Interest rates going up is going to kill the housing market. The problem I have with that is it's never killed the housing market in history. There's high rates always at the peaks of housing booms. That's how it works. The demographic and the inventory gets refilled. So the demographic runs out and the inventory gets refilled. That is the end of it. And usually it has very high rates. So someone would then draw the conclusion that high rates killed the housing market, but it didn't. The demographics ran out. Go look at the 1970s. Run a statistical analysis on the population with respect to interest rates and housing starts. Do the whole thing. And I've been doing this. You could even look at Edward Lemer's paper. He's done the same thing. You could probably just look at his paper and read the whole thing, and you could draw some conclusions from it. it is a upper level read. You have to know statistics kind of quite well. And I've gone through a bunch of statistics. And then you've got people out on Twitter and they're saying the demographic doesn't support. You can't even get the demographics right, guys. I'm sorry. You can't even get the demographics right. Chart the population over time. Just chart it. And then calculate a mean, and then chart the difference around that mean. And then show you where the rate of population growth are at. Now, if you can't do that, you probably can't even read the data correctly. If you can't even figure out what I just described there. And another thing, it's not about the chart patterns that are necessarily that are being showed. It's not the chart patterns, just the pattern. Look deeper than the pattern. Look deeper than it. So what you want to find when you look at all these things is you want to see an alignment. It's all about alignment. It's not about I see pattern, therefore it goes down or therefore it goes up. That's the lazy person's investment, one-on-one. And you can draw these lines all over the place. I get it. Technical analysis isn't supposed to be the only be-all tool. What I like to do, or what I try to find, is alignment between many things. I want to see something that's very cheap. I want to see inventories being drawn down. I want to see a chart pattern that looks pretty good. I want to see all these different things align. It's not just one thing. And then you have to realize that, when you evaluate commodity sectors and you're using all these charts for bottoming patterns, that's not what you want to do in some of these other sectors where they control the selling price of their products. That means the company's probably going bankrupt. You have to know the difference between all of this. You don't just plug it all into one shot and then say, hey, look, this biotech company's got a bottoming pattern. It's like, I don't play with biotech. There's no point for me to be there. I want something that is low because the commodity's low and it can turn around very quickly. You're selling a generic item, a generic commodity. So I'll go through some data here. We'll run through it real quick. Right here it says USO, that's the crude it's a ETN, I think, or it's a ticker for matching crude. It says why crude oil may be on the verge of an even larger breakout. And the summary here, I'll just kind of read through the summary. Both U.S. and OPEC crude oil output remains abnormally low due to many financial, operational, and regulatory issues facing new oil well drilling. Since U.S. drilled but uncompleted oil well inventories are reaching extreme lows, we may soon see production decline as new oil well production levels deplete without replacement. The economic slowdown may cause some declines in oil demand, but demand appears unlikely to reach supply unless draconian lockdown measures in China spread. The lockdown, I agree with all this. As long as crude oil is in a shortage, USO is likely to have a positive carry due to heavy backwardation in the oil future markets. That means that the near-term pricing is very expensive in relationship to some of the future pricing. Overall, that's what backwardation means. Overall, while demand fluctuations could halt oil's rally, it seems more likely that crude will reach a new all-time high this year due to the output gap and abysmal storage levels. And that's what I've been looking at, is the inventory storage levels, and the output is not improving because we can see the storage levels decline so much. I agree with this, with what this person is writing, because the inventory backs it. Now, when I look at all this stuff, and I look at a lot of inventory, that's basically the tell-all of everything. That's when prices start to move, is when inventories run out or get to a very low level. Now, here's a clip from it. It says this was the closing statement or conclusion from this article. Assuming the short-term price demand elasticity of crude oil is still around minus 0.05, the oil price would need to double for only a 5% decrease in demand. Long-run price elasticity is less extreme, and elasticity measures are not always reliable. Still, considering there's still a 5 to 10% supply-demand gap and no reliable signs of output normalization, crude may need to reach the $200 to $300 level for the shortage to end. Wow, that seems pretty similar to the predictions that I was making based off of ratio analysis. And ratio analysis is just a repeat of history. So if gold price is 2,000 something dollars, we go to a 1 to 10 ratio. That means it's 200 and something dollars, or $300 if you go to maybe a 1 to 8 or 1 to 6 ratio. All depends on how much money is in the system and what the ratio compresses to for the supply and demand. It says here, I just grabbed this because somebody had a question. It says, I would love to hear an episode where you and Finding Value consider the possible sequencing of these commodity opportunities, the order of runners in the commodity bull run. It seems like energy will have one race and infrastructure will run another. I think that energy is probably the most important because it has tertiary effects on all of the other industries. And those tertiary effects they're going to push the prices a lot higher, but I don't know if the companies will make that much more money. And I've been mulling this over for a while. Will an aluminum company that has extreme input energy costs make more money in a very high energy environment? And what I put below this is traders worry zinc could see volatile moves after nickel chaos. LME says it's aware of zinc tightness, monitoring all metals. I don't even know what that means. What are they going to do? Shut it down when it starts to go vertical? And it says zinc market is tight after smelter cutbacks on high energy costs. That's the driver. The driver of all of these things is high energy costs. And when you look and tie it back, we need to cut 5 to 10% of supply, which could end up with far higher energy input costs across the board. So what we're seeing and what I think is happening is we're going to see natural gas in some areas of the world go berserk, like Europe and China has. It's going to spread to America. It's going to spread to coal. It's going to spread to oil. It's going to spread to uranium. And we're going to just run from one shortage to another shortage to another shortage to another shortage that renewables can't make up. Because guess what? Renewables are subject to these metal markets, which are having cutbacks because of high energy costs. The largest input of renewable energy, their costs, is energy costs. It's a self-feedback loop, and it's being subsidized by fossil fuels. And I don't know how people can't figure this out. I don't know why. But, some of us who have figured it out will make a lot of money probably from this. Now, let me go into some of these areas and show you what is going on. So here's out of aluminum. Trafigura says global inventories will be exhausted by early 2024. Here is the look of that. Now, I look at this and it's like, well, maybe we should invest in aluminum. But I go back to this quote here. Zinc market is tight after smelter cutbacks on high energy costs. The root cause of this is high energy costs. That's what's going to blow up aluminum. I mean, sure, some of the aluminum companies are hedging their energy input costs on the markets. I saw Century Aluminum was doing that, and some of these other guys I'm sure are doing it too. But this is coming, guys. This is what drives the charts. The patterns that you're trying to look for on the chart, some of them do match this to the T. Others that people are trying to draw on the charts of topping patterns, I don't think are necessarily right. Not if this is coming in front of us. Aluminum's going to go higher, and I think it's already had a pretty good run, and it'll probably run again. It's probably the first wave of that first move. This is coming. Now let's look at a whole bunch of stuff, and I'm going to read some things. It says, this is about aluminum from the article. It says, the deficit is now moving at such a speed that it's unsolvable, actually. Trafigura, one of the top traders of the metal, isn't alone in forecasting higher prices. Goldman Sachs sees aluminum hitting a record of $4,000 a ton within the next 12 months as buyers face unprecedented supply tightness. Still, Mueller's prediction that inventories will be entirely depleted in just 2 years highlights the potential fireworks that some traders are bracing for. When you look at these numbers, you would need huge demand destruction to balance the market. He said, it's difficult to be short in such a market. All of what they are saying in these articles is huge demand destruction to balance the market. Let me go up here. What does this say over here? It says, still considering a 5 for 10, demand gap and no reliable signs of output normalization. What does that mean? It means demand destruction. We need to reach far higher levels. Now, everyone's talking about a recession. A recession is going to happen. Why? Because prices have to go up and we have to literally squeeze everything out. I think that interest rates are going to go up as a result of this, not as a driver of it. As a result. Now here, let's keep going. World faces shortage of lithium for electric vehicle batteries. Lithium emerging supply gap. So here's the supply gap of lithium. These are the charts that I think are creating the technical patterns on the other charts. Lithium demand and supply in a net zero carbon scenario. This is demand. Here is your gap. That's just massive coming up. The gap is coming soon at any point. I can't tell you the exact timing of this gap, but you know what? I'm positioned for it. The finding value, I have one company that I think is a really good bet on the Finding Value website Platinum membership. If you want to know what it is, I've got it there. It also has uranium in it. That's all I'll say. Coming on up, let's keep going over some of this stuff. LME zinc prices soar as inventories tumble. The LME zinc stocks are falling off a cliff. Prices are reacting as such. And I don't care what the demand and all these people talk about. The inventory is the most reliable thing to look at. So when everyone talks about real estate, they're like, oh, well, the demand is going to get hit and the supply is going to come on. I don't care about that, guys. Those are all opinions and projections. What is the inventory doing? And what is price responding to that inventory? That is your final say. And inventory is a real-time measurement of the markets between the supply and demand. If you have more demand than supply, your inventories get drawn down, just like we are seeing in zinc. Prices react accordingly. And this takes time to build back up. It's not overnight, just like the real estate market and just like all these other long-term things. The reason we invest in these things is because you can't respond quickly. Uranium's going to get squeezed. Energy's going to get squeezed. Zinc's going to get squeezed. Graphite's going to get squeezed. Lithium's going to get squeezed. Cobalt's going to get squeezed. Copper's going to get squeezed. Nickel's going to get squeezed. I can go on and on and on. That is what's driving these patterns. Now, let's read some of the what they said during this article. It says, an LME spokesperson said, we note the current tightness in the zinc market and are monitoring all metals closely to ensure market activity remains orderly. What are they going to do? What are they really going to do? They're going to shut it down? They're going to manipulate it? I don't even know what that means, what they're trying to say here. It says zinc is leaving the LME system because of significant shortages created by producers cutting output due to record power prices. Production of zinc is energy intensive. So these energy intensive processes are going to shut down. Where's the root of the problem? Energy, energy, energy. It says we've also had these very high freight rates. Wonder who's playing that market. Finding value, freight rates, especially container freight rates, which have impeded the flow of metal from one region to another. So now freight rates are starting to increase and energy prices are going to increase. All at the time that we need more volume in this world. And if energy prices are at the root of the problem, do you think that we are going to be able to build ships if we can't even build zinc and copper and nickel and steel and iron ore? This is going to get really tight very fast. And money is going to flow to these areas because this is where the money is needed. It's not going to go to some frivolous thing. Oh, I'm just going to buy you're not going to be buying anything because nothing's going, well, you're not going to be buying a lot of other things because those things will be difficult to get, period. They're all going to go up. Anything of real, with minerals and energy already sunk into it, are going to become infinitely valuable with time. I've said that multiple times. Now here's this. Is there a copper shortage? Diminishing supply from currently operating mines combined with the projected increase in demand for copper concentrate over 2021 to 2030 would result in a 3.85 million ton production shortfall in 2025. So the experts are predicting this big shortfall coming in 2025. You have to position now before all this comes. That's all I'm going to say. And are you going to see me selling these because we have a short-term pullback? I'm going to start laughing if you think so. I'm buying everything. Give me it. Now here's another article. Copper supply to catch breath in 2022 before heading for a significant deficit. So basically we got a pullback here. What do you think I might be doing if it's catching a breath and I know that there's a shortage coming sometime out in the future? Now these estimates might be off. But notice something. What is the market doing? What are they doing? They're locking down China. They're locking down all these things. They know this is coming. They know it. They know the demographic is larger in America. They know that inflation's coming. They know they have to raise rates. All of this stuff is the markets forcing the Fed to do it. They aren't going to raise rates because they want to. The market is going to force them to. That's my take on it. Feature. What about tin? Tin maintains record-breaking run as short-term issues add to chronic supply tightness. Add tin to the mix. Tin market chronically undersupplied. Demand likely to grow more significantly than supply. That's from that article. Coming on over here, let's keep looking. How a global nickel shortage could disrupt the electric vehicle industry. Shortage of EV battery raw material graphite could delay global drive to go green. Wait. So we've got tin going short, we have copper going short, we have nickel going short, lithium going short, cobalt going short. Is there any chance that the electric vehicles are going to have any chance to really ramp their production if all of these materials that go into an electric vehicle are going to go short? I don't know, but it seems unlikely that they can ramp this up as quickly as they want. Graphite is used for the negative end of the lithium-ion battery, known as the anode. While graphite deposits are not scarce, the supply of battery-grade graphite used as a raw material in EV batteries is much tighter. This is the supply-demand balance, and look at the demand of the red line versus the supply. It goes ballistic after 2025. 2025 seems to be the year that things go ballistic in a bunch of different materials. We're front running. We are early to this game. And you have to ride through the volatility, guys. That is what it is to feel like it. This is what it feels like to be very early. And we have a couple of picks in graphite on the Finding Value website channel. In fact, we are playing all of these potential areas, everything with companies. I've got at least a few that I think are really good plays. Platinum membership, sign up below. You can find out. Now here's another one. The long squeeze. And what is this? It says tin's backwardation is one of the longest ever seen in commodities. Backwardation means that there's cheaper prices out in the future than today's prices. Now, look what's going on here. The maximum number of days in backwardation. And some of these are out of backwardation, but tin's still ongoing, but some of these have ended. Palladium in 2019, platinum in 2003, sugar, cotton, lead, copper, lumber in 2021. Tin is still ongoing. It's going to maybe hit some records up here. Brent crude in 2020, coffee, nickel, orange juice, gasoline or gas oil, soybeans, and so on. You know what's going to happen? We're going to see a whole bunch of these go into backwardation in a gigantic amount of different metals and energy and all sorts of stuff. So when I look at all this stuff, guys, I see this. This is what I know. This is what I look at. This is what's on my Finding Value website channel and in the educational areas. I talk about all this stuff. It's on there of the supply demand balances. The charts are there. Yeah, that's fine. And if we go in the short term, if we pull back, that's just a buying opportunity to me. But this is coming, guys. It's coming. It's ahead of us. And the demographic supports it too. If you look at the data, at least correctly, in my opinion, you got all these other people that are just, I don't know what they're doing. You almost have to go Han Solo on all this and figure it out yourself, because everyone else, half their data is garbage. But some of this data, I mean, it may not be 100% accurate. We may be off a year. Who cares? I'd rather be a year early than 2 years late, because this is all just going to go as it goes down the line. Energy driven. Energy is the root cause of this stuff. Look at the 1970s. Demographic driven by the real estate market was the translation of money into the system, coming into home buying years, and then after it, they spent a lot of money. They went in their max spending years. They're earning and spending years for the baby boomers. This is coming on the supply side. We have liquidity coming in, supply being restrained. What do you think that's going to do to inflation? What do you think that's going to do to this consumer price index numbers if all of these input costs are going to go vertical? How do you position for that? What is the best positions for that? Most people know how I'm positioning it. I know this is coming. Finding Value website in the link below, Platinum membership. That'll get you exactly how I'm positioning. You can see all the companies I'm buying. You can see how I'm positioning physical metals, what I'm buying, and all that stuff, if you're interested. But I look at all this, guys, and I know I get questions about trying to address technical chart patterns. Guys, this is behind it. Those patterns, if they're short term, it just means you're going to get a better buying opportunity if it were to break to the downside. Would I sell assets, some of these really good assets in great jurisdictions of this world? No. No. Because guess what? If that pattern doesn't play out and it gaps higher, well, what happens? You just missed the best opportunity of your lifetime? This is only going to come once, guys. It's not going to come a whole bunch. And, this could have larger ramifications to your currency. I mean, this could be more significant than what most people think. This could destroy currencies. I don't know if it is. We'll find out. We're going to find out here in a couple of years. We're just early to this mix. We'll see. We'll see what happens. I think the second half of 2020s is going to get pretty hairy. It's going to get pretty hairy. And if you want to ride it, ride it with me. Other people presenting this to you, give me a thumbs up, subscribe to the channel, subscribe to the website if you want. Platinum membership. I know I'm kind of pushing it a little bit. That's just, I'm supposed to. But if you need help and you want to ride this together, yeah, sign up. Sign up, and we have a training session on technical chart pattern that, I called it Technical Chart Patterns and My Approach to Investing. My approach. And that's what my approach is. And I'll go over this too in some of the things, and you can do question and answers. That is Friday at 7 a.m. Mountain Standard Time if you want to participate in it. It is this Friday, 5/6. I do not have a question and answer session this weekend. On Saturday, I got to do something on Saturday, but I substituted the Friday morning one with technical trading. I'm going to record it and post it on the website for everyone to view if you're part of that. And you can see how I approach things. And remember, the value here is not just looking at what I am buying. The value deep down is educating yourself to become a better investor and be able to hold and position for things that are coming in the future. The puck is being passed in this direction. That's what's coming next. How do you play it? What do you play it with? What are the best things to purchase in this type of environment? And that's a lot of the stuff that I go over. And ask those questions. It's fine to ask those questions. But if you guys like this content, thumb up, subscribe to the channel, and we'll catch you next time. This is Finding Value.